Good morning, Mr. Manoj. Good morning to all of you.
Good morning, everybody. Good morning, Mr. Kannan.
Yeah.
Good morning, everyone.
Good morning, everyone.
Good morning, everyone.
Hello. Yeah, you just mentioned we are gathering and start in 2 minutes. He has made you. I don't know. I will check with.
Yeah, check it. And then I'll start.
Yeah.
Good morning, everyone. We are starting in 2 minutes. Gaurang, I have made you co-host, so you can share the screen.
Thank you, sir.
So shall we start with today's session?
Start.
Good morning, all of you. Special conclave today, Meet the Experts Think Tank. Very warm welcome to all participants. Myself, CA Manish Mahendra Sangvi, Think Tank Multidisciplinary Global Platform, Chapter Leader, welcomes you all to Think Tank Global Conclave for India Growth Story and Meet the Expert series covering in detail Management Think Tank, Valuation Think Tank, IBC Think Tank, Financial Reporting Think Tank, Vera Cooperative Think Tank, FAFP ISA Think Tank, IPOs Think Tank and Capital Markets Think Tank. As a major part of Think Tank at Vivek.Patra. Vivek in Sanskrit means knowledge and wisdom. Patra is an innovative news updates containing slides on sharing latest developments and real-life examples by CEO, CXO, CFO, specialists, and professionals with a global experience. Today, we have a Think Tank Multidisciplinary Global Platform special meeting for all stakeholders in finance, corporate affairs, industry, and profession. Think Tank has been in existence since over decades. Idea for this is conceived on 6th January 1991 to have a conferences, conclaves with CEO, CXO, CFO, panelists, and specialists sharing experiences and real-life examples. Our panelists are finance leaders working in reputed companies or professions since many years and have a deep domain knowledge. Think Tank platform now digital has got overwhelming response globally on digital mediums and expanding rapidly through LinkedIn and Facebook, etc. Our participants and experts have a rich experience in industry and professions who have done ICAEW, CPA, CFA, CFP, IIM, CA, CS, CMA, ISA, DISA, FRM, IFRS, BTech, Masters, PhD, sharing their experiences, knowledge, wisdom, spreading as a reach out initiative globally through www.thinktanks.co.in and in spite of limited resources. Due to overwhelming response to our annual reports, corporate strategy, and ESG, we have announced 6P awards and recognizations, that is Profit, People, Planet, Professionals, Promoters, Platform, for corporates annual reports, analysts, professional achievers, CEO, CXO, CFOs with a very respected jury, with a rich experience and interaction with stakeholders and boards. This recognition and awards would be announced with a rigorous process of scrutiny and choice and interaction with the participants and would be given digitally and if possible in a well-located auditorium in Mumbai like Yogi Sagaguru or similar when available, subject to the pandemic rules. As participants are aware, recently we have launched a very much awaited referencer, a kind of newsletter, appropriately titled as Think Tank at Vivek.Patra, India Growth Story, a comprehensive conference material compilation of over 600 pages, sharing experiences by CEO, CXO, CFOs and specialists with latest development in series on blocking, regulatory, frauds, financial reporting, Ind AS, IBC, taxation, digital, capital markets, technical analysis, ISA, bank audit, corporate affairs, and would be available for subscription and any ethical contributions by well-wishers, etc. We will also be covering important and latest development as suggested by many participants in coming weeks. Example, valuations and financial modeling, health and wealth, cyber security, blockchain, MSME, etc. We request all to subscribe to our Think Tank YouTube channel for watching summits, conclaves, webinars, and join, connect, and network on Think Tank webinars group on LinkedIn and Facebook pages. Telegram channel specially created on suggestions of many participants and panelists. We once again welcome all members, and panel shares a few insights on Vivek, Think Tank at Patra India growth story. I specially thank my colleagues in the digital global team, Anupam, Aditya, Ajay, Anurag, Aishwari, Archana, Hemant, Mitesh, Mihir, Malvika, Nipun, Nischal, Pramod, Praveen, Rakesh, Rucha, Pramod, R. Kannan, Manish, Santosh, Subrat, Snehal, Sandeep, Unmesh, Vijay, Vikash, Yogesh, and others for regularly contributing to Think Tank at vivek.patra. Today, we have an excellent Think Tank multidisciplinary platform seminar with eminent stalwarts and specialists sharing experiences and latest development. Let's have an interactive event. Thank you all for joining. I would like to say, Manoj guys, something. You say something, and then Gaurang, you have to start your startup valuation. Thank you for.
Thank you, Manisha. It's indeed wonderful to be out with you all today. Very special series which has been very successful on startups and private equity valuation. We had recently management of National Stock Exchange, which has plans to list so many startups for the India growth story, continuing regularly so many listings of startups and creating wealth. We have seen very good returns promoters are getting, plus investors are getting on startups. A very special session and special day. We just had a monetary policy yesterday, accommodative monetary policy. Deep, although not many changes, but deep impact on economy, global changes, inflation, GDP, growth rates, liquidity, special things. So we'll have a very interactive discussions. Year has ended also, lots of expectations on results. Dynamics are changing of industries, mutual funds, financial services, industries. So lots to look forward to. And we have, as usual, lots of experts, senior top corporate professionals, industry captains, young professionals. Gaurang, young professionals, a very excellent start last month to financial modeling basics, going ahead to advanced. Ultimately, the whole game is about creating value, right? Rakesh, you are also here. We had a series on valuation, and now there are new things coming. Registration of valuers is essential. Great professional opportunity for all. Ultimately, we had to create value for entrepreneurs and startups and investors in an ethical way. Mr. Kannan, you would like to say a couple of words before Mr. Gaurang starts? Mr. Kannan, you are there?
Yeah, I am there.
Yeah, and then Rakesh, you say a couple of words, and then Gaurang, be ready.
Yeah.
Mr. Kannan, I would say, is a senior top professional, has worked with Tata Group, ICICI Group, Hindujas, looking at performances of so many sectors, and worked at board level of so many companies. And couple of words from you, Mr. Kannan.
Yeah,
and then we had the session on startups, and we'll make it very interactive as usual.
Yeah, I look forward to this presentation on startup valuation. This is And as we're all aware, in the last 1 year, a lot of startups, in fact, even those who went and listed, I don't think they expected this type of success when they thought of going public. I heard from one or two promoters where their initial estimate of raising funds was much lower, but they are able to enter and raise. And of course, unlike in the case of traditional company valuation, people adopt, of course, I know about 12 methods by which you can value a startup, but that is not restricted to only 12. There are many ways. In fact, there are new ways which are emerging on how to value a startup. It's a all new game, all new business, and of course, unlike in a traditional brick and mortar model or traditional company model, here it's all based on how fast you are able to go and ramp up the business, and if you are able to establish a proven business model on a smaller scale, how that can be rolled out not only within India but across the world. That is what we saw one of the Indian companies which is offering this service as a service. So they were able to go and raise funds from NASDAQ. And after that, of course, we saw many companies which are able to go and raise funds. Now SEBI is thinking, since you're on the topic of valuation, now there are some SEBI has started looking at, after seeing all these big successes and after this prices started falling, SEBI has started looking at the, again, re-looking at the model of allowing startups to get listed and the valuation. Anyway, I look forward to hear from Mr. Gaurang Shah on various methods by which you can value a startup. Like I said, the field is still evolving, I would say, based on the new business models which are emerging. I remember in 2000, how they used to value a startup was internet boom. There was internet boom. So how they used to value a startup was that whether they make profit or not to look at that. So they say that this company has made a loss of $100 million. So which means they have made a big investment and these customers are going to be there with them for another 15, 20 years. So they used to multiply the loss of $100 million by 20 times, 30 times and say that was the valuation of the company. Of course, we know what has happened after that internet boom. There was internet bust. But unlike in the internet boom, what we see here today is that we see really operating models. Companies like Ola, Uber, Zomato, they are all value to customers in the sense that we are getting value as a customer. But only thing is that the business model which they have, still they are not able to make it profitable. So that is the only issue. So if you have to say that valuation, maybe you can make a loss for 4 years, 5 years, but how long you can continue to make a loss and still preserve your value? That is the question yet to be answered, because as I said, the field is still evolving and we have to wait and see how this will take shape. But one good thing, like a company like Nayaka, I used to sit with the CFO in the CFO conferences, and 3-4 years back he was saying that they are EBITDA positive. And what I hear from the promoters is that they're talking about capital allocation, capital efficiency. So they will not do business just for the sake of ramping up. So some of those principles they talked about. And I can tell you again, valuation, I give you 2 examples. One is this Nayaka. Other one is your DMart. So these two companies are very, very focused. So unlike others, they are not ramping up a big, they are not growing very big, but they define the territory well. They try to make very good profits, and they are trying to set up a model, something similar. I hope something similar will happen going forward in startups. Thank you, Mr. Manoj.
Thank you, Mr. Kannan. Rakesh, you have been a registered valuer also, and looking at startups earlier as a banker
Yeah.
and in industry, and now as a professional. A few words from you for about a couple of minutes. Then we have the presentation for Gaurang, which we'll do very interactive way as usual.
Thank you, Manoj, for giving me opportunity to speak on this Vivek Patra on startup valuations. We have to understand first thing, valuation is a specified subject on which everyone or a valuer should have a proper qualifications as well as experience of the industry as well as the businesses practices, and then he can do the valuations. Valuation is such a topic which I can speak on days together, many days together. But today, when Gaurang will take up the startup valuations, as we know, India is a pool of new generation or the people who are very young. And if we see the change in the world, we find that the young people who are residing in India are having multiple ideas which they want to implement for the betterment of the society. And this is the main point which startups are doing. They take one problems and try to resolve with the new technologies. And that's why when you look for the valuations, their valuations are skyrocketed. The recent past, we have seen so many valuations, the startup valuations, which has come to the public, and public are also mad behind all those issues, public issues also. We have to understand the business model have changed from manufacturing to service and service to now to technology driven industry. So when any startups comes up and their valuations need to be done, we have to look for the new approach, new methods to compute their performance. Earlier, the profit was the only yardstick to value any company performance. But now multiple factors are being decided during the valuations for any company. If we talk about the even the recent past Zomato or any other company, they have multiplied the sales for the doing the valuations. So these type of changes which has not been seen in the past, and that's why I always say that the startups are those companies who are really want to change the landscape of the industry as well as the service sector. So today we have a very fantastic session on the valuations and basically specifically on startup valuations. So anyone have any doubt, we can discuss this through the chat box. And we know Gaurang is very good in data analysis as well as to do the valuations. So we have a very learned speaker today, and I hope everyone will enjoy the today's session. Thank you. Thank you, Manoj.
Thank you, Rakesh. One thing about Gaurang is Gaurang has recently done a special advanced course on valuation with Mr. Ashwath Damodaran, right? he has interacted with him, and Damodaran, he writes his blog and looks at valuations of all the dynamic companies coming out with listings. Goes right, sometimes goes wrong, sometimes, but intricacies of the valuation, he is known to be a guru in American University and shares advanced valuation knowledge. And Gaurang has benefited from that and would be sharing his experience also. Gaurang, a few words about yourself, then about your knowledge and experience on the subject of startup valuation with real life examples, as usual.
Thank you so much, sir. First of all, myself Gaurang Shah. I'm a register valuer, and I have done valuation of more than 100 plus companies in recent past 3 years, which includes startups as well as traditional companies to real estate companies, including the financial assets and various other instruments and various other startups from automotive to agriculture to tech companies. And I would also like to thank Manoj sir for inviting me again at the ThinkTank and giving me the opportunity to deliver the deliver session on startup valuation. So the flow of our session for the today's session will be, first we'll be discussing about the performance of few startups, Indian startups, which have recently went for the IPO. Then continuing that, we'll be discussing few international companies which were earlier startups and then from quite a long time have been listed on the IPOs, and what are their performance and the valuations. These companies would, well-known companies will include Tesla, Rivian Automotive, Meta, that is our Facebook, and Amazon. And with that, we'll be discussing about the methods for valuing a pre-revenue startups. Pre-revenue startups are one of the most challenging valuations because, we don't have any historical background of the company, historical financial background of this company. And so using DCF or any comparables is cannot be used, and that's the challenging, and we'll be we'll be seeing how these startups are valued. We'll be discussing Berkus method, scorecard valuation method, risk factor summation method, and venture capital method. So to start with Indian startup performance, there are I have jotted down 5 companies. This chart we must have all seen about the performance of these startups which had listed from July 2021 and their performance as on this. We can see the Paytm going for IPO in November 21 with issue price of 2,150, and then it has been dropped to 71%. Then the car trade, again it has dropped from its listing prices to 61%, Policy Bazaar to 21.5%. Zomato and Nykaa have been positive from their listing price, but there's a huge decrease in share price, huge decrease in value post the IPO from their best ever listing price, stock market price. We can see Zomato being 50% less from what it has its best stock price, and same is with the Nykaa, around 28%. Now we'll see how the international, so these companies have newly listed in Indian stock market. Many of us feels that the investors, the early investors, are sort of a greedy and had intentionally listed this price at a very high so that they can earn huge returns from there. Whereas other side of the coin says that this company, this startup environment, IPO environment is very new in India, and Indian people have not even, Indian investors, retail investors have not evolved to invest or, to mark these companies. These companies usually, will make losses in the couple of years before going to the profit, and we'll see how this how the international startups have performed, which are already listed in the indexes from from many years, not just couple of years, from many years. So we'll start with Tesla. Interestingly, if you know, Tesla was not co-founded by Elon Musk, though he is now the face of the Tesla, but it was not co-founded by him. It was co-founded in 2004. In 2001, 2002, and Elon Musk invested in the company in 2004, becoming the largest shareholders. And Tesla is it is into the electric vehicle manufacturing, but it is a more technology driven company than an regular automotive company. You can see the market cap of Tesla. This chart many of us have seen, those who are regularly into this finance part. The Tesla capital market cap is close to $1 trillion, whereas the next nine automotive combines valuation is $1.01 trillion. So Tesla's market cap is very huge. It's very huge. Its next second market cap is of Toyota, or in the automotive industry, which is close to 280. So almost it is 4 times than that of Toyota. We'll see this numbers, some of the interesting numbers. So valuation of Tesla is 1.1 trillion, whereas that of Toyota is $280 billion. But the sales of Tesla is close to 44,000 millions, whereas that of Toyota is more than 2 lakh. So even if the sales of Toyota is 5 times, its value is 1/4 of that of Tesla. And similar is with the net income. The net income of Tesla, we can see, is 5,500 millions, whereas that of Toyota is 25,000. Still, its revenue, its market cap is 1/4 of that of Tesla. So this is the stock price of the Tesla over the period since the time which it has listed. We can see from 2010 when it got listed, since then up to 2020, there was not much impact on the share price. There was a little bit over here in 2014 and 18 between that, but not much. In 2020, it is the time when the Tesla, where earlier also we used to selling the models, but in 2020, in around 2017, it came with Model 3, which was one of the best electric vehicle in the whole world. And post that 2020, it has expanded its market to across the geographical worldwide. So it has came up with the factories in China, in Germany, and also second factory in Texas itself. And post that, it has revamped its manufacturing capabilities, increased the sales. It has reached 1 million, first company to sell more than 1 million electric vehicles. And you can see the increase in stock price from 2020 to 2022. There's a huge increase in that. So we can say that during this time from from 2010 to 2020, it has been continuously building a product. It has been incurring the losses, a very minuscule sales, but it has been building the product, and we can say within 2 years it has monetized all the expenses, all the capex which it has incurred in the previous years. Now we'll talk about the Rivian company. It's an automotive company. Again, an electric vehicle. It was incorporated in 2009 and went to IPO in 2020 at an IPO of $78 per share, through which it rose to 170. So almost its market cap, its valuation went almost twice. Okay. Interestingly, so with the IPO coming, it has, being one of the top 6 valuable automotive vehicle companies in the whole world, but it has sold only 920 units in 2021 with a revenue of just $55 million. We can compare, the Toyota with 280 billions and selling with a revenue of 200,000 millions, whereas Rivian Automotive is just with the revenue of 55 millions has came to IPO with the IPO value of $86 billion, close to 86 billion, which it has rose to 170. And this is the chart. So post, it has, all from its all-time high, it is currently at 75% down. It's, I guess, yesterday's stock price is around 38 USD. So interestingly, this, how the valuation of the companies is very interesting in the startups. It is not that, big, it has sold all its shares to the retail investors and the big investors that have existed. Amazon and Ford are one of their largest shareholders, accounting to 17% and 11% respectively. So there's a electric company, there's a vehicle automotive company which has invested in, there's a technology company, Amazon, a giant technology company which has invested in it. And its stock price has went down to 75%. It's interesting that how valuation plays in this role in these companies. Now we'll see something about our beloved social media, the Facebook, which have re-Christianized itself to Metta in an attempt that the company wants to grow beyond the social media platforms and want to enter into the digital virtual reality, that is the metaverse. The company has relaunched itself into the metaverse. And interestingly, if we see the valuation of these companies, the stock price movement, the announcement of renaming itself came in October 2021. And when such big announcement comes, there has to be some increase, some impact on the stock price, but there wasn't any impact on the stock price. If you see around in February 20 over here, the stock price has suddenly reduced. It has drastically been fell, and it was in the one single day, it has fell to 26%, which is very huge for a company which is into top 100 or top 500 market cap. A 25% decrease is a very huge decrease for such companies. So one must presume that it must have a very bad quarter 4, so let's see what are the financials of the quarter 4 for the company. So if we see the revenue for the quarter 4 was very good. In fact, one of the highest revenue over all the geographical areas. We can see the net income also being, it's not on year-to-year comparison, it is less. In quarter 4 of 2020, we can see there was 11,219 millions, which was reduced to 13,000 1,285 million. That's a change of 10%, but that's not a very huge and a drastic change. We can see the cash flows, how the the company in Q4 has one of the best cash flows, free cash flows generated. And if we know in DCF, we generally, the focus of the DCF method for arriving the valuation is using the free cash flows which a company has earned. So despite having recording the best free cash flows, company's market cap share price has dropped. So what was the reason for that? The reason is the company's daily active users from around 2 billions, that is 1930 millions, has got reduced to 1929 millions. So there was a slight drop of a million out of 2 billion active users. There was a drop of just 1 million, and this 1 million drop has caused 25% reduction in market cap itself on that single day. So from this, we can understand that for such startups, social media, technology-based startups, daily active users, subscription, downloads has a huge impact than the traditional revenue, net income, and the free cash flows of these companies. One of the reason of this reduction is that not that the people have stopped using the mobile phones and the smartphones and everything. The reduction is that the people have moved from using Facebook to Instagram to TikTok and such other social media platforms. So this gives us the a very interesting that valuation of these companies which have been listed from quite a long time, which are into the market from quite a long time, and have also invested in various other companies and startups. Still, their valuation is backed by the users, downloads, and the subscribers. Now we'll see about the Amazon, how the Amazon over the period have performed. We can see the net income of Amazon from 2004 to 2021. See its revenue from 2004 to almost 2015 is more or less on the same line. Compared to that, what it has gained from 16 to 2021, we can see a huge increase in this net income. This is exactly what has happened to the Tesla also, and that is impact that can be seen in the share price, the market cap of Amazon also from 2000 somewhere in when it has got IPO'd in 1998 till 2013 or maybe 2016, we can see the stock price movement and a drastic increase in the stock price from 2016 to 2021. Why has been a huge drastic is because over this period from 1998 to 2016, Amazon has invested huge in expanding these geographical areas from US to Europe to various other developing countries in India as well. It has within this period, it has developed more areas of revenues from e-commerce. It has AWS, that is their cloud base, then to the physical stores which it has launched, and some gateways, payment gateways it has launched, that Amazon Pay and everything, and that has monetized in this 2 years. This 2 years it has monetized. So from this we can know from the Amazon and the Tesla that the business cycle of these companies, of the startup companies, is way different from that of a traditional business companies, the life cycle of a traditional business company. In a traditional business company, there's an introduction stage where company has a low sales, little bit of profit, or in initial period, a couple of months or year, it's making some losses, and then it is slowly getting into the growth stage, then to the maturity, and then it declines. If a company evolves into the new markets, new products, then the life cycle continues. If not, then it perish and it get declined, and ultimately it gets diminished. So this is the traditional license. This is the life. This is the business cycles which we used to learn in our college time, that any company's business cycle is there. It has an introduction stage, growth, maturity, and then it declines. But this has now changed. With startups coming into the picture, the whole business cycle has been changed. You can see here the company's growth for a long time is very minuscule. This is exactly, we can compare it with the Amazon or the Tesla, that it's it's been searching for quite a number of period. It is looking for the product, for the right products, then how to monetize how to create a channels and monetize those products. And once the product is fit, the channel is fit, then the monetization comes, and the monetization comes at a steep growth, at a very steep growth. So this is the life cycle of a non-traditional company, of a startup company. And this is what makes interesting and challenging for arriving the value of these startup companies. It is not, we can simply use the DCF or comparables, though one must think that the ultimate goal of these companies, of any companies which are valuing, is what the future economic benefits which they will give. Maybe not in a couple of years, maybe a decade or something. It might take some time.
Gaurang, just a request, can you zoom this slide? It's very interesting. Yeah, great. And do share the presentation later on with Manoj sir and others.
Yes. I have already shared with Manoj sir. I have made some couple of changes in that, so I'll share the fresh one with the Manoj sir. So you can, I guess this is visible now.
Yeah, better. This way looks better. Show both. Maybe a discussion on this, then on the newer model.
Yes. So I'll discuss on this again. So this is the chart. This is the chart which earlier we used to learn in our college time, that how a business will grow from introductions, and there will be a steady growth in the sales during the growth stage, and then the maturity, and it will decline. Or if the company has evolved, it will again start the cycle. The cycle will get extended with the new products they will be launching. This has changed with the coming of startups. The growth of the startup in the initial period is very minuscule. This is the time which they are incurring huge capex cost into the building the market channels, into building the right product for their customers and everything. And in fact, sometimes building the industry itself. There's a lot of time when the industry itself is not there, and you have to make that industry. And we can see the steady growth in the revenue, or the EBITDA, the net income of this startup. Once they monetize this channel, this capex which they have already incurred in the past. And this is a similar chart, comparable chart for the Amazon, for the Tesla also, how in the first initial 10-15 years their stock price was has not much moved, but in the recent past, in the recent, once they has monetized, it has a huge steady spike in their value in their stock price. So we'll be now discussing about how to value pre-revenue startups. Just excuse me. So the challenges with the pre-revenue startup is it has not yet earned any income. It has not yet made any sales. And defining the market, defining while using DCF, though the DCF is one of the best way to value, DCF still uses the historical base for the assumptions of the future. For respect to the sales, with respect to the EBITDA, with the respect to its cost structure of the company, even though, we can say that the company will currently, let's say, is making a loss of 30%. And over the period, it will improve and meet the market standard of 20%, let's say. But we need that base of 30%, which is not in these startups, which are pre-revenue startups. So how we value these startups is a very interesting and a very challenging thing. So we'll be discussing 4 methods here. First is the Berkus method. Second is a scorecard valuation method. Third is a risk factor summation method. And fourth is a venture capital method. So in the Berkus method was devised by an angel investor, Dave Berkus, in mid-90s. And the core of the Berkus method is to, how to value an early stage startups without relying on founders' financial forecast. Founders can, forecast itself to X times of increase in revenues and growth. But so we cannot simply rely on what founders is forecasting. We have to apply our own mindset on old, research and everything, and then we'll have to come up with the valuation of these startups. So Berkus method is one of the method on how we can value these early stage startups. Berkus method is is created. It has 5 categories. And numbers are adjusted according to the current market, like geographical or industries, and are adjusted based on that. We'll give you an example of how it has been valued. So the 5 characteristics, these are the 5 listed characteristics. One is the sound idea, that depending I missed one point, that based on the characteristic, a maximum value of $500,000 is jotted down to one characteristic. That if up to 500,000, a characteristic will be allotted this value. So it can be from any value figure. This 500 is not fixed. It will depend upon your industry. It will depend upon your geographical areas also. So it is not, but there is a standard of each category to be allotted $500,000, up to $500,000. These 5 characteristics are, one is the sound idea. So depending upon the idea, the valuer will assign a value between 0 to 0.5 million. The second thing is the quality of management team. This is one of the most crucial part of a pre-revenue startup, that is the management team. Similarly, allotting the value, assigning the value from 0 to 0.5 million. Then the second is the prototype. If a company has already developed a prototype or a product is ready, might have a higher value, will be allotting a higher value to them rather than a company who has not yet developed or is in the stage of development and needs the funding to develop those prototypes. Second thing is the strategic relations, that is the market channels. If the company has already assigned those market channels, or if a management team has a huge network, which means once the product is launched, they'll be able to market those product very easily, and product rollout and sales, which is with respect to the revenue growth and the profitability. So for each characteristic, we assign values on up to 500,000 millions, and then we sum up all this valuation, and it will give us a pre-money valuation. So how practically it is being used is, first we compare it with we need to pick a company which is comparable to that company, our target startup, and based on these 5 characteristics, sound idea, quality management team, we assign value comparing to that companies, and based on that we assign the value to each company. So what are the pros and cons of the company? Pros is it's a very quick and a high level, and then does not rely on the forecast. The cons are it gives importance, same importance to all these 5 characteristics. This is the main, that it requires a skilled and an experienced valuer, so that they can with their experience allot a best value to each characteristics. It ignores other detailed areas. We'll be discussing more in the which other areas which this Berkus has ignored in the upcoming methods. And it depends, like I said, that we first have to pick up a comparable company, a comparable startup which has recently been valued, and we will be taking the benchmark as that. So the benchmark is set. The next method we'll be discussing is the scorecard valuation method. In the scorecard valuation method, it's similar to the first method. You have to find a average pre-money valuation startups, comparable startups in the similar geographical and industry of the target business. Then determine the individual weighted average, and multiply the resulting factors by averaging those values. So here are the list of areas, comparable companies. We can see, if we added this, it comes to 100%. So these are the 8 points. That is the strength of the management team is given 30%, size of the opportunity 25%, product type 15%, and the list goes down. This is a standard percentage, maximum percentage allotted in the scorecard valuation method. So now let's take us an example. So area of comparison, these are the 8 comparison, and these are the maximum percentage been allotted to each. Will be comparing one-on-one comparison with the target setup. So if our comparable startup strength is less of the management strength, and our target is better management team. So let's say our founders, our target startup valuers team, management team is much better. The founders are much better. They have already had some historical history, has some history of building a similar app or some different app and exiting at a very good value. Will be assigning better percentage to them. Similarly with the sizes opportunities, there can be a downgrade to that also, like the product. Let's say if our comparable company's product is much better than ours, and marketing channels, they have a better marketing channels. They might not need additional investment, but we might need more than the current size of round and others. We multiply it. So we arrive at this target setup, target percentage. Then we arrive at the weightage factors, that is a simple multiplication. and we arrive at the total. So over here we have the total of 113.5%. So how do we arrive at the value? Let's say of a comparable startup, the value of the recent value is, let's say, $500 million. We multiply with this percentage of 113.5 and arrive at our company's pre-value, our startup's pre-revenue valuation of 5.67 millions. So what are the pros and cons of this startup? It has more areas than Berkus methods. It is relatively very easy and straightforward, and it weights each area very differently. The cons are that first is you require a very skilled valuer, which has the experience in valuing such pre-revenue startups. It ignores some of the detailed methods, and again, it is dependent on the appropriate benchmark. So if this comparable company which has selected is of 5 million, our valuation will be according to that comparable company. Yes. So can you please explain again how do we arrive and compute? So as I mentioned, we'll be comparing. So first we'll pick up. So how I'll explain again. First we'll pick up a comparable company, comparable startup, and based on the area of comparison, these points which I have jotted down, we'll compare each characteristic with our target company's characteristic. So let's say the strength of our management team is better than that of a comparable company's startup which we are valuing. Will be accordingly, valuing a higher person, will be, appropriating a higher percentage to them. How this 125 I have arrived is purely based on valuer's judgment. That is where I said that it requires a very experienced valuer, a skilled valuer to allot those assumptions. Obviously, those assumptions can go wrong. But more or less, if a company, a valuer is good and has a great experience, nearby the percentage of this 125% will be okay. Similar, we compare with the size of opportunities, and we compare all these characteristics, and we jot down those target percentage to them. How better our startup is than it's comparable to the comparable startup. And there we multiply, sum up, and we arrive at the percentage, and we simply multiply the percentage with the comparable valuation, comparable startup valuation. I hope that's clear. Moving on, the pros and the cons. We have already discussed this. The next method is the risk summation method. In the risk summation methods, there are 12 risks that are jotted down. These are the risks that a startup has managed, and based on the assessment, a valuer must assign these points between -2 to +2. That is, either it is very unfavorable or favorable. It it generally doesn't go beyond -2 and +2. Similar to the previous methods, we pick up a comparable company, comparable startup, and then we assess the risk of those startup. We adjust. We then we first assess the risk of those comparable startups. We compare it with the risk of our startups. We then assign the values of between +2 and -2. For each +1, our value will go up by 250,000. And with each negative, similar, it will be dropped by 250. So here are the risks, 12 risks which has been categorized. First is the management risk, stage of growth, ledger, political risk, manufacturing risk, marketing, capital, and all the other 12 risks. We jot down, similar to the earlier method, that is of scorecard. We compare it with our target revenue, our target startup, and a valuer will assess and jot down the points over here, the numbers over here. Let's say as in the previous case also, our management company is a better. So in the similar case, we'll add 0.2 plus 2. Let's say the stage of growth is similar. There's no change in that. Let's say our company has a higher political risk than that of a target, than that of a comparable startup. So we'll point out -2. If we have a better manufacturing capabilities, +1. We have a lesser risk, funding capital risk than that of a comparable company. So +1 to that. Competition, technology, litigations, and all this we assess. We sum up those summation methods, all these 12. And so in our example, if you see there's a +2, we multiply +2 by 250 and we arrive at the value. So let's say our target, our comparable startup value, company's valuation was 3 million. And based on our risk assessment, we have come up with a +2. We multiply it, we'll be multiplying with $250,000, and our startup valuation will be 3.5 million. In all these three, one might question, how will we able to get the comparable company's valuation? So that is the case where, these companies like VC circles or such, other such websites which publishes those startups data regularly. Those are the paid subscription which valuer generally pays, and we get those comparable companies valuation and the other data also. What are the pros and the cons? The pros are it has considers much larger areas than Berkus and scorecards. The cons are it weights all the areas equally important. It only looks on what company, on what startup can go wrong. It not looks for the positive aspects of the startups. We are assessing the risk, not the opportunities. As in the previous, it requires a skilled valuer. And again, it is dependent on what appropriate comparable startup we have selected. So our next method is a venture capital method. In the venture capital method, we start with the endpoint, keeping an endpoint in mind. We estimate the terminal value, the value which a VC fund is looking at the time of exit. This is again basically the value of a similar startup that has undergone a merger of acquisition or a transaction or an an offer for a buyout, etc. Based on that, we first estimate our required return on investment from the startup as a exit multiple. The VC fund might look for 20x or 30x return at the time of exit, and to arrive at what X, what ROI we are looking for, we look for a similar startup, similar VC fund which have invested in a similar startup and what returns they have made. Then we arrive at the post money valuation. That is simple. We divide the terminal value by the exit multiple. We then calculate the pre-money valuation by post-money less the round size, and we also account for dilution since VC fund, we are investing at a very early stage, and will be our equity share will get diluted in future when the next round of funding are there. We account for dilution as well. So let's take an example for the same. Let's say there's a similar startup to the one which we are valuing, and it has recently exited at, let's say, $50 million. And our VC fund expects a multiple of successful investment of a 20x multiple. So with that, we arrive at the post-money valuation, that is 50 million divided by 20x. That is the return which we are expecting, and we arrive at the 2.5 post-money valuation. With the post-money, to arrive at the pre-money valuation, we simply minus the post-money valuation with the funds which we are raising in the current round, that is 0.5 million, and we arrive at the 2 million valuation. And as mentioned, we account for dilution, that is in our case, we have assumed it to be a 50% dilution, which we are considering. So our pre-money valuation will be 1 million. So what are the pros and cons of these venture capital methods? Pros is that it is useful in calculating the required valuation for a pre-revenue expected return. The cons are it doesn't look into the other aspects like team, technology, the revenue, traction which it has created, the market capabilities, the opportunities. Similarly, it is depending on choosing the right terminal value. The right terminal value, I mean to say, is similar that will be choosing the correct comparable companies. So we have gone through these 4 methods, and which are the how to use, which is the method to use is for angel investors. It is best is to keep it a simple method. You can use a combination. We can use Berkus as well as the scorecard valuation, arrive at the value, and take an average or maybe weighting. You can use weighted average methods and arrive at the value. And ultimately, it's jotted down to what are the investors' preferences, what is the size of check they are looking, at what stage our business is, and the reason for investing. These are the things to keep in mind while picking the right valuation methods. So before closing our session, I would like to pick up 2 case studies on how Flipkart has Myntra was acquired by Flipkart, and how that valuation Flipkart must have valued Myntra. It is they must have used DCF and comparables, but one of the best way to use in this current transaction is how much cost it will take for Flipkart to create a similar app and a brand, and how much time it will have to take. So let's say the Myntra has been in the industry and has created has a revenue and number of users and number of gross merchandise value it has been created, and what is the what will be the cost which the Flipkart might have to incur is the assessment which a valuer does to arrive at the valuation. Similarly is when the Facebook has acquired WhatsApp, what was the cost, what was the value they have put up. It is like that the WhatsApp was acquired with 19 billion by Facebook, and many feel that it was very huge, since the revenue of WhatsApp was close to around some millions dollars, I guess some 50 odd million dollars, and it was valued at $19 billion. So what exactly was, how it was valued. It was valued on a similar basis, that how much cost it will have to create, it will, have to incur to create a similar app, as well as other factors. It has taken into consideration that Facebook Messenger, similar, the message delivery app, message app which Facebook has built, had a lower billion message per day than WhatsApp. So it was to kill the competitor, or acquire the competitor. It was also fear that Google, Microsoft might acquire it and monetize from the same. So before the competitor acquire our target company, we throw in, the Facebook throws in the huge amount and acquired the WhatsApp itself, and it will later on will try to monetize the same. So thank you. This was my presentation, quick presentation on the pre-revenue, how we arrive at the pre-revenue valuation method. There are various methods. I have just jotted down and discussed on the 4 methods, but there are other methods also, like cost to build up method, comparables transactions methods to value. But in the current session, we have discussed only 4 methods. I'm happy to take any questions.
Yeah, Krishnan Iyer, if I may, can I ask a question?
Yes, sure.
And a very good session, very good insights, which and you kept it very simple at valuation. It's a very complex. You made it very simple. Okay, so keep it up. And looking forward to similar sessions on other methods in future. So my question is just connecting the dots. See, initially you said that the prices of Amazon and Tesla also didn't shoot up. Okay, maybe suddenly there was a spurt after certain years of IPO. So do you think similar can happen with Paytm or car trade also? Maybe not now, few years down the line.
That could happen. That could happen. One must, while assessing the value, one must, look into that the business model. What is the current business model? It is very at a very initial stage, we can say, though the startups are in quite a long time, but still the market has not evolved. Still, they have not monetized from those. If you can, compare it with the Amazon. Amazon is also e-commerce. The Paytm is also mainly into e-commerce business. We cannot compare it with Tesla because Tesla is into manufacturing. What Amazon has done was also similar. It can be in a similar line that it had, incurred huge losses in the initial period. Getting into the market, it was an aggregator. Similar is a Paytm. Paytm is also an aggregator. It has not yet monetized. It has, as of now, it has get into various revenue source of streams, from insurance, from mutual funds to Paytm, to gateways, to wallets. It has, applied for banks also. So yes, if their business models changes, so for Amazon also, what has changed that it has expanded its geographical locations to other countries. It has get it into the other revenues. The best one is the AWS. It is one of the cash cow for the Amazon. Amazon is still incurring losses in their core, of e-commerce aggregator, but it is it's a cash cow from there with respect to AWS services which they have provided. Similarly, once the market develops the OTT platforms, the Amazon Prime, the music services which the Amazon is continuously providing, it charge some 100,000, some 1,000 rupees. And it is incurring losses, but once that market is developed, it will earn from that. Similarly, for the Paytm, for the Zomato, they have, as per my concession, their model is not yet. They have the network, they have created the network, but they're yet to build the model, a perfect model. And once that perfect model is built, the perfect product is built, obviously, as per my thing, as per my assessment, their revenue will shoot up and their income will shoot and their valuation will shoot up too.
Okay, Kannan, thanks again. Very good.
Gaurang, you said you have done quite a few valuations, about 100 over last 3 years. What will be the average size and which sectors generally?
Sectors, if I can say, they are into various sectors from agri-tech to eco to chemical industries to fintech services, also to entertainment business or to entertainment, startups also I have valued. And the range has been from the market, the valuation from 2000 crores to some 100 crores of, for startups and for startups which are at seed funding rounds to 100 crores also.
That's quite interesting. And we have seen recently Walmart, which picked up a stake in Flipkart.
Yes.
And they are looking at a valuation in a couple of years of 60 to 70 billion. Really multiplier. At that time, people said, oh, how can somebody pay about 1 lakh odd crores, right? And just they want an entry, maybe they were so late, but this shows the type of valuations and wealth creation possible if you get your technology, what people just call an app, but it is not only an app, it is all about service delivery and customer satisfaction.
Yes, that is true. That is true.
It shows the type of multiples possible of our wealth creation. And in case of much smaller ones, bases, it can be much, much more. And as we said, you have covered a few methods in future series. Expect more from you on much more methods, much more real life examples. Gaurang, can you share the latest dynamics for mutual fund slide?
Yes, sir. So there's one question from Mr. Falgun. A startup company is in existence in 3 years and I have made investment in the business, resulting into heavy debt losses. The sales have just started to come. How do you value such company and what factors to be considered while making the financial projects of these companies?
Falgun, you can put your video on and speak also. That will be much better for better connect. Falgun, you are there?
So answering to them, the first thing is...
Yeah, hi. Hello.
Yeah, Falguni, can you put on your video and mention your qualification and your area sector, and we can have a better interactive connect. Yeah.
Hello.
Yeah, Falguni.
Yeah, hi. My name is Falguni Vastani. I'm a chartered accountant and I've been into in the profession for last 15-16 years. My area of interest is, I have a practice since last 5 years and my area of interest is more into valuations. So that's the reason, I'm keen on, attending all the valuation kind of seminars and webinars, whatever are there. So my question is, and this is more of a practical, I have a few clients who come up with these, when you practice, you have more of smaller clients to deal with. And they are normally not that established and not that standardized or those kind of things. So there, what they need is a little guidance on how to deal with those clients. So one of our clients is that they've set up a company which is more like the cosmetic business, and they would like, and they have a group which is backing this this setup, and they into the business in the last 3 years, and they are just trying to put in more products. And so they invested a lot of things into assets and those built up those assets, and they are currently having losses for the last 3 years because sales have been down. 2 years they were down with the COVID, so because of that also they couldn't capitalize on the sales part, and so they have debt. and they have losses. Now they need, the funding to come up from the strategic investors. So how do we look at these kind of, and they're looking out for valuation, when they have to speak to these strategic investors, obviously they will ask for some kind of valuation, what they can give. So how do we value such companies, and what factors should we consider when we're making the financial projections for them?
Okay, ma'am. So as I can see, as per the brief you have given us me about the company, about the startup, we can say the startup is currently at a pre-revenue. It has just started to make the sales. So the first thing which as a valuer we need to do is, first we have to assess the business, assess the technology, whether it is the company has made the capex, the company has incurred the losses and has had a huge debt. First we must assess whether those capex are a good capex, whether the company will be able to generate revenue. Just because the founders and the management team says that we have incurred 100 let's say 10 CRs of investment and obviously will be earning from that, we must first assess that whether those capex which has the investment which the company has done is a good or bad. If it's a bad, then I guess there's no need to further get into the valuations part, because the company doesn't have any investment to monetize, to get a better monetize. If it's a good investment, first is, since it's a pre-revenue startup, I would suggest to look for a comparable company. Now, comparable company, the biggest challenges which we face is, getting the exact comparables. If the exact comparable is not there, then we should, broader our area into larger part. So let's say if a company is into, as you said, is into cosmetic company, let's say is making a facial cream. Now, the facial cream, if let's say, if it's for a man, a facial cream is that we have companies who are into cream specifically for men. So we can take those. If those are not available, then we can, expand it to the other, let's say, other geography, other products also. If that is not there, then we can, just increase our bandwidth of the standard of the industry and pick up the closest related comparable companies. We can pick one or two or more also, and then we can compare it and we can arrive at the value. With respect to the forecast, as I mentioned, one must assess first of all whether it's a good investment or bad investment, and then based on the market research, there are various reports which are available, various paid reports which give you the market, market of 4-5 years also. We need to take those reports, study the reports, and based on that we can make the financial projections.
Yeah, thank you. That's quite informative. Yeah, that's helpful.
Yeah, Krishnan, if I can ask one more question.
Yes, sir.
Now you spoke of Zomato. That is what prompted me to ask this question. Now companies like Zomato, see, correct my understanding. I'm not a techie. I'm trying to be a finance pro. Okay, more personal finance. Okay. See, the technology of Zomato can be easily replicated or copied by few techies also coming together. They can build it up faster. But again, if you take a company like Hindalco or a Tisco, that is going to take humongous time to build a steel or an aluminum plant. So how do you give weightage to valuation when technology itself can disrupt a technology?
So with respect to Zomato, as Manoj sir initially mentioned, I had taken a course of Professor Ashwath Damodaran, Advanced Solution course, and in that we had to pick a company, an independent any company, and you have to arrive at a value of that company. I had picked up Zomato as my company because it has not yet listed, but it has just published its draft DRHP with the company, and my value was rupees 32. My per share value was rupees 32. When you say that the technology can be easily replicated, it's a big disadvantage. It's a big advantage, but one should take into consideration that the network which the Zomato has created over the period of time. If today, if I want to start, even if I have a billion and 100 and 200 billion dollars of funding, but for me to replicate Zomato as it is will take time, will take at least 3 or 4 years, because the Zomato has created a new network for itself. It has penetrated into various cities. I just cannot, come up with the money, take the team force and, expand all together at once go. So that is a challenge. Obviously, the company which are easy to build are also easy to destructive, as is the case with the Facebook, which I have earlier presented. It's a tech company. It's similar. It was easy to create, and it fell 25% just with a drop of user, daily active user of 1 million. Of the 2 billion user active, it has dropped just 1 billion, and it can destruct.
Yeah, thanks for insight.
I hope I have cleared.
Yeah. Thanks.
Mr. Kannan, you are there?
I'm there. Yeah, I'm there. Yeah.
Mr. Kannan, your take on the dynamics of valuations and the fluctuations. We have seen Paytm, which Gaurang discussed, a range of 25 to 100% in a matter of 6 months. Policy Bazaar, a range of 50%. Same way Nika, and of course we have so many more examples.
So like I said,
So Kannan, just put your video on. If you
yeah. Like I said, even the promoters, they did not expect this kind of valuation to come. That's one.
Gaurang, can you remove the slide and bring on the next slide. After this, we'll start the MS session.
So in terms of valuation, there was a discussion on how to value a brick and mortar company like Hindalco and Tisco, and you have this Zomato. There is something called network effect, especially in companies which are in e-commerce, where the number of users go on increasing, the number of services go on increasing from the other side, the valuation obviously goes up. That is one. Second is that there is always a first mover advantage, where the company which comes first, we all know that today, I think BSE created the fastest trading system in the world 5 years ago. So they are the fastest trading system in the world. But still, because NSE was the first one to adopt this technology, despite BSE coming up with such a fast technology, they are not able to match up with NSE. So similarly, when we come to valuation, as I told you, obviously all these companies, when they went and raised money, the market sentiments were excellent. They're very good. In fact, nobody expected that this kind of response from customers. And I think one of you mentioned that the understanding of retail customers about this business are not that good. So once a success was seen in IPO, then everybody was very fast enough to go and file the red herring prospectus. They filed the prospectus. They started raising the money. Then, of course, we had some setback. Now people are going slow. Coming to Paytm, I think it was very well explained by the presenter that a company like Amazon was not making money for a very long time. So what has changed? The business model of Amazon has changed. Actually, even though their main business is e-commerce, most of the money for them today is coming from AWS and cloud management services. So that is what is making money for Amazon. That is how they were able to go and create a value for themselves. So one of the things which Paytm also what we are saying today, if you see the number of users in India on any tech platform is the highest in Paytm. Yeah. But every transaction somebody does through Paytm, actually Paytm loses money, your UPI. So there was a discussion about monetization of assets. Right now, Paytm's advantage is that it has the maximum number of users in the platform. Now they have to develop a strategy whereby how these users can be converted. We all hear about concepts like cross sales, upsales. How you are going to convert these customers into buying insurance, buying car insurance, buying health insurance, buying a home loan. So how this platform can be used for creating businesses which will generate surplus for the company. So that is a big challenge now. So as I said, even today, the maximum number of users on any platform in India, it is the highest for Paytm. No doubts about that. So the issue is that they don't know, or they have still not come out with a strategy, which is ensuring that they are able to convert these customers into profitable customers. So they have to make these customers into profitable customers. So what all they have to do, they can do, I don't know. They can even include education also. Now you are talking about super applications coming from groups like Tata's and all that. So taking platform as a business, taking the maximum number of users in the platform. Now Paytm has to come up with a strategy whereby they are able to monetize not after 4 or 5 years. They should be able to monetize the contacts they have within 1, 2, 3 years. That is the only way Paytm can create value. Yeah, thank you.
Thank you, Mr. Kannan. As you mentioned, Tata's have launched a super app on April 7th, trying to integrate most of the Tata companies which are getting consumer centric. Some companies have joined, others, many more are expected to migrate soon. So, and there are many other groups also which will be looking at it, whether a super app is essential or one should have individual brand. Normally super apps are very difficult to success. Branding is very, very important, but it's a conglomerate and it's an experiment, and being consumer centric, new Tata, let's see how it develops and creates value for the customer and efficiency of the app in comparison with the competition, huge competition. Flipkart app, Amazon app, they have really excellent track record for delivery. Now, I think there was one more question. Gaurang? Gaurang? Okay. Till that, we'll have a look at the latest dynamics of the mutual fund industry. Where is the liquidity flowing? The year has ended. Then we'll discuss the RBI policy. Mutual fund industry year to year in a very difficult year has shown March to March growth of 20%. 20% is phenomenal, particularly when the GDP growth has been quite low and uncertain environment, and everybody has been talking about retail investors getting direct, and FIs have been withdrawing funds. But mutual fund has come of size. 43 mutual funds, total AUM leaping from 32.1 lakh crore to 38.37 lakh crores. But what is interesting is the market share and the ranking. There is a huge divergence in terms of growth for the last year. Significantly, we have seen mutual funds growing at upwards of 100%. There are some upwards of 800%. There are even some large mutual funds over 50,000 crores growing over 60%. Quite interesting. And some over 1 lakh crores also coming down by 1%. Some mutual funds are getting sold. Why? They want to focus on the core competence. That happened to L&T mutual fund. Got picked up through a bidding process to HSBC, right? IDFC, there were a huge number of bidders, foreign bidders, private equity bidders, joining local partners, and the deal just got announced a few days back. So IDFC getting a bid, and hopefully with regulatory approvals it will move to new hands. Valuations between 3 to 4% of AUM and a growing industry. What can be observed here, which I would like to have comments from people tracking the sector. HDFC mutual fund are known to be among the most consistent performers, has grown only by 4%. And moving down the market share, ranking from number 2 to number 3. Hopefully it is only temporary. There is a change in management. It has got a new CEO. Maybe the new CEO doesn't have the skills to increase the AUM like the previous CEO. The new CEO is an investment guy. Maybe he would like to get more into investment and manage the fund or manage equity. But it surely shows HDFC mutual fund, the team, whole marketing, the 4 P's of marketing, product, pricing, promotion, and place. It needs gearing up significantly. SBI mutual fund, a type of kind of a joint venture, public sector culture, 28% growth. We have not seen this type of growth earlier. Today, you go to any branch of SBI, most of the branches, you will find somebody will asking you to invest in mutual fund, either in a tax saving scheme or in a fixed income product. They are not worried about competition with the state bank deposits. Growing at 28%, phenomenal return. ICICI, among the leaders always, growing at 15%, a steady rate, a steady performance. Aditya Birla mutual fund, we have discussed that several times. The IPO came and also the performance of the Aditya Birla NBFCs, growing at 10%. So, but maintain the market share. Kotak Mahindra getting stronger and stronger. Quietly over the last 5 years, it has moved up the market size, and it has maintained a market share, 22% growth. Nippon could maintain a market share, 24% growth. UTI, 22% growth, maintained the market share. And the ranking of number 9. DSP maintained number 10. So the top 10, HDFC mutual fund, a new CEO, underperformed, significantly. I hope underperformance doesn't continue for long. Some managements give the CEO a few quarters, some give a few years. HDFC management is known to give number of years to the team. So hopefully they are getting their act right. But overall 20% growth, moving up. What we have seen, FIs are selling, but who is buying? Mutual funds have become of age. When you have AUM galloping by 20%, it has become a strong industry by itself. And these are data given by MP India. And we'll have much more dynamics. Hopefully the industry will grow for continue growing at rapid growth, and the mix will change. Consolidation is there. IDFC mutual fund, L&T mutual funds are being taken over, and more plans getting launched. Interesting. We have one mutual fund going up by 165%. EPFAS mutual fund. They had a few schemes. They have been launching more schemes and investing in global markets also. Baroda, BNP Paribas mutual fund. We have seen now getting a joint venture partner, BNP, and now started growing. Hopefully it will grow much faster. But again, very interesting thing, LIC mutual fund. We are talking about LIC, the Goliath, the giant, LIC IPO coming. Only 5% growth. 22 rank in the market. Very poor performance. Why it is not growing? Is the management not focused on mutual fund? Are they getting into too many things? Insurance, banking through IDBI, which is also apparently on divestment mode. But LIC mutual fund needs to reevaluate the strategy. And lots of other interesting things. Quant mutual fund, 800%. So Navi mutual fund, a new fund, just crossed 1,000 crores, growing at 49%. So new entrepreneurs, not expected. White Oak, that was the latest thing on a deal with Yes Bank mutual fund, just about 100 crores. Shriram mutual fund, always the lowest rank, but the consistent, it remains in the sector. It was a track record of over 30 years, 200 crores, not growing much, but strengthening his management team. Hopefully with that, we may expect much more performance. Mr. Kannan, your thoughts on mutual fund dynamics?
Dynamics.
And
As,
what is your reading? And then I would request Mr. Krishnan also to share his views.
As we are all aware, the last 1.5 years was very good for stock markets. And I can tell you, in fact, even in corporate sector where a lot of professionals are there, they don't invest directly. So they feel investing through mutual fund. One more thing I can tell you, all these bankers, since they are lending money to corporates, all these bankers are not allowed to directly invest in stocks. So one good thing what has happened was in line with the market sentiments. When the market was going up, in fact, one of the wealthiest segments in India, that is the leading corporate leaders, the leading bankers, they did not have a choice but to invest through mutual funds. That's one. Second is this concept of SIP has really worked well. And what we saw was that market was going up and up only. So people are gaining confidence and putting more money. And what we hear, it's not only the experienced investors, even youngsters who are in college, they started, in fact, when we hear about demat accounts being opened, I don't know whether they themselves deal with it or not, but a lot of demat accounts have been opened in the name of youngsters, more than 1 crore or 2 crore accounts. So most of them were youngsters. So the number of retail participation, apart from mutual fund, actually it has increased. Retail participation has increased. And as I said, mutual fund, since all these experts, they know that markets are doing and they need to invest. Actually, their alternative was only to invest through mutual funds. So this is what I think has really given a push to mutual fund. And on this FII, of course, we know that a lot of money was going up. We will come to that when we talk about RBI policy. So whatever was being taken out by FII, it is partly being offset by mutual funds as well as individuals. So that is what we see. So still the market sentiments are good. The people are saying, even though we have the war and all that, I keep hearing from people that if there is some good news, war is going to stop, markets will still start going up and up again. And since this concept of SIP was taken off well, and so far, people are not complaining. Only thing now, I think the mutual funds relating to debt funds started doing badly. Now there is expectation that interest rates in the economy will go up. So what will happen is that the debt mutual funds will become little unattractive. That's all what I want to say. Thank you.
Thank you, Mr. Kannan. Anybody else would like to share any thoughts, any question?
Yeah, Krishnan,
Yeah.
sir, if I can.
Yeah.
Hey, again, good insight. Again, just to add a piggy bank from where Kannan sir said, yeah, SIPs are becoming extremely popular. Okay, almost 8,000 to 11,000 crores of consistent SIP flows, the industry is saying. And also debt, also BAF as a category is becoming popular. Few mutual funds, BAF AUM has become big. So it needs to be seen as to how, rising interest rate and volatile equity, how the same is managed. So that could put pressure on the fund management and also result in impact on the AUM. If you see amongst the listed AMCs, you spoke about HDFC. There is one more P which can be added, especially with parlance of mutual funds. That is performance. Okay, so HDFC schemes of late they are picking up, but still, if you see over a 7-year period or a 6-year period, many of their flagship schemes are underperforming. In fact, it's extremely striking as a shareholder. I don't have any HDFC share. Okay, they over last 1 or 2 years, just to get their act rights, they had around 3 fund managers from outside to manage the equity. Amit Ganatra from Invesco, then Gopal from Mirai, and the latest is Roshi Jain from Franklin. So these are industry veterans with their own skills. Okay, so that goes to show that something HDFC mutual fund needs to get their act right, especially when it comes to flagship equity performance. But if you look at the reverse, UTI mutual funds, across their schemes are definitely in top quartile. Majority of their top, it is equity that makes money for the AMC. Okay, so if you see, predominantly all their funds are doing good, and also even UTI has had its share of attrition. Many fund managers are moving. In fact, even recently one of their fund managers has moved. Their CIUs also moved last 3-4 times. But still, if you see the BCP or the process is very good. And just to speak about process, ICICI mutual fund is known for attrition. Okay, there are, even today, if you see, there are 3-4 CIOs or CEOs who are ex-ICICI bro. For example, Axis Mutual Fund CEO is ex-IPRO. Okay, then just to add again, White Oak, Motilal X is also ex-IPRO. These are some of the popular names. But still, if you see the BCP or the process of IPRO mutual fund is very consistent. But their funds may not be in top quartile, but what matters over a long period of time is consistency, which I feel iPro, Shankar Narayan and team are able to do. And same is the case with Kotak. Kotak is again, Nilesh is doing a fabulous job. So these are some of my thoughts.
Thank you very much, Krishnan. So lots of expectations from Kotak, from ICICI, from Axis, and above all from HDFC, and a new entrance, Bandhan GIC, Chris, right, who have now bid for IDFC Mutual Fund, 4,500 crores. So interesting dynamics, but the main thing is at what rate they will grow. Hopefully they should continue growing over 15% and become a force to reckon with. Now, before we move to RBI, anybody else would like to add anything? Manish? Sanjeev? You are there? Any thoughts? So we will move on to RBI policy, which just came in. Yeah, these are the headlines. RBI policy. So quite interesting. Some say nothing in it, but some say a lots in the RBI policy. Decoding the RBI policy, Mr. Kannan, and then we'll have a detailed discussion, deep dive into it. Mr. Kannan?
Yeah.
The headlines, what do the headlines say? And deep dive into RBI policy, including new innovative SDF.
Yeah. So now, 1 minute. Closing. So the RBI policy, like I was telling earlier also, RBI policy, like I was telling earlier, today if you see the inflation, it has got nothing to do with the demand for funds. In fact, we have a lot of liquidity of funds in the economy. And for various reasons, the requirement of funds are not heavy. For example, you take large companies, many of them are still operating except 2-3 sectors where we find buoyancy, especially metal sector and all that. We don't see buoyancy in automobile and many other sectors like tourism, accommodation, travel. Of course, they're picking up now. So all these sectors, they don't really require money. That's one. Second is, most of the large companies in India in the last 2 years, what they have done, whenever the going is good, companies, they do not mind having more capital, less capital efficiency. But due to this pandemic, every large company was forced to look at their capital efficiency. So all of them went back to the drawing board and saw that they are having more capital than what is required for doing the business. So they were able to reduce the capital required for the business, and many of them were able to repay the loans also. In fact, in the metal sector, we know that a company like Tata Steel, they are able to repay loans higher than what they were expecting that they would repay. So we find that that was happening. And so the fund requirement, of course, when you come to SMEs, that is one area where they require funds on a continuous basis. And still, I believe 40% of MSMEs, which were affected by pandemic, even though the GCS scheme was being brought by government, I can tell you more than 40-50% of MSMEs, they don't borrow from the banking system. So all those MSMEs who got benefited from the government policy, they are all part of the formal system. Whereas there are many MSMEs which are depending on their own funds or which are depending on other funds. So we hear that still many of these MSMEs are still in trouble, and they are not yet able to come back to the original level. And of course, coming to consumer sentiment, and what we found in the last 2 years, of course, India, we have one of the largest savings in the world, and also people have started spending money. But due to pandemic, the willingness to spend, of course, the ability to spend is there with the Indian people. By nature, we Indians, we save a lot of money for the worst days. So people have money, but the level of spending has come down. But one good thing is that in the RBI statement also, they are seeing that some green shoots in rural and urban economy. But one more thing, the rural economy, as we are all aware, it is being supported by NREGA scheme. NREGA, as you are all aware, the government was budgeting more than 1 lakh of crores and ensuring employment to at least one person in a family for 100 days in a year. So what we found in the last financial year, actually for the demand for NREGA also has come down, which means people earning from NREGA, actually they were down. But one good thing, you know, that the World Bank has released a report where I think now Indian government has again extended the scheme, I don't know, up to September or October. So for 80 crore people will get free ration. Free ration. So that is one thing which has helped to reduce the poverty. So this is the background. And of course, the last 2 months, what we saw, when the budget was prepared, the assumption regarding the oil price was $70 per barrel. And we did not have the war. So, and government was comfortable. One more reason why there was no need for funding also. Actually, government has collected a lot of money through tax, both the direct and indirect tax last year, which has made government finances very comfortable. In fact, it has helped the government to reduce the amount of borrowing they could have made. So, all this has led to liquidity in the system. So when the RBI policy will be effective, only when there is a demand for funds is very high and supply of funds is very low. Whereas we have a case where the demand for funds is very low and availability of funds are higher. So the problem of inflation is not related to the demand side, it is related to supply side. As it was clearly defined by RBI governor. One is this: now they expect oil price to average $100 per barrel this year instead of 70 earlier. Then he said that due to this crisis, the price of edible oil have gone up. So there is other one leading to inflation. So now whatever inflation we are seeing, and of course on the automobile side, we know that chips are not available. And there are supply chain constraints where ships are being held up in ports, not able to move the cargo. So all these are leading to higher demand for products, higher pricing, higher inflation. So in this context, the policy, in fact, I was also arguing that RBI has to reduce interest rate. Even now I am saying that actually the policy, even if they had increased the rates, it would not have helped with the liquidity, but it would have helped with the sentiment. What is sentiment? So we know that FPIs, they always go to a country where the interest rates are high, the return on investment is very high. So if you ask me why so much money was withdrawn by FPIs in the last year, according to me, I don't know, I may be proven wrong. According to me, if RBI has given signals in terms of increasing the rates, and of course, actually today you talked about this new rate, 3.75%. So that has been the minimum rate now. So the reverse repo rate of 3.35% is not valid anymore. So anyone who is going to borrow, they are going to borrow at 3.75%. That is the one, and they also introduced that that MSS that facility where it is 4.25. So now the rate is actually not 3.35. It is 3.75 to 4.25. So RBI not increasing the rate, actually it gives a feel-good factor to all of us. But I can tell you, whenever a foreign investor comes, they always look at the interest rates prevailing across the nations and see which country has increased the interest rate. And the money always try to flow towards the country where interest rates are higher. That is one of the main reasons why we found that in India, the foreign portfolio investment saw a outflow. So that is only from that point of view, RBI should have increased the rate. Otherwise, I don't find any other use. But at the same time now, I'm happy that they changed the stance. They're always saying that CPI will be below 666. And now they say they're showing next 2-3 quarters, slowly it will come down. So at least they are accepting the fact they have reduced the growth rate for GDP. And they have recognized that the inflation is likely to be at a higher level. And they also expect interest rates to move up. And so there is a sentiment which has been created. But if you ask me, if only they had raised the interest rate by 25 basis points, some of the FPI outflows, what we see today, they may not go out. And of course, after the policy was made, several experts were being interviewed. So what they were feeling that this year, India might raise the rates between 25 to 50 basis points in 2 to 3 tranches. That is the expectation, even though they have not done it now. So they expect that they will go and increase the rate. And as I told you, increasing the rate by RBI has a big relevance for FPI inflows. Even though we can discuss that we are getting a much higher FDI, etc., but the one flow which is going to affect the market is FPI inflows. So we have to at least make sure going forward. I'm very happy that in fact on Tuesday I will be speaking in a conference on how to achieve a $10 trillion economy. So if you ask me, we have a lot of positive points in India. And one good thing is that now it is being seen by the world. And it is being projected properly to the world. And also our implementation of policies in India have really improved substantially in the last 1 year. So these are all good signs. So if we have to manage, of course, I have an expectation that if this PLI scheme takes off very well. Last time we introduced this Make in India, which is not supported by incentives, which is not supported by implementation of these schemes. Whereas this time they introduced this PLI scheme, it has been supported by funds, and now actually people have started coming in, and I'm happy. In fact, I'm attending the India strategy report released by Australian government day before yesterday. All of you know that this FTA which we have signed with Australia is a path-breaking one, where 96% of the products which we export, they'll be imported in Australia without any duties. It includes clothes. Similarly, 75% of imports from Australia will not attract any duty. So far in India, we are discussing only about increasing exports. But our policies were not consistent with increasing the exports. Again, if you look at the statistics of trade in India this year, most of the increase in exports of India has come from petroleum products. Petroleum products, we don't have it ourselves. We have the refineries, we import, we process, we export it back. So on both export side and import side, the big growth what we have seen was in petroleum products. Whereas there is a big need for us to diversify into all other areas. So I'm sure this PLI scheme, I think last year, India was the second largest exporter of automobiles in the world. And we already started exporting mobile phones in a big way. Samsung, I think Samsung has exported the maximum number of mobiles from India. Like that, when the PLI scheme comes, I'm sure we will, we have a competitiveness in 10 industries as of today. We have IT, we have ITES, we have apparels, we have engineering services, R&D. So about 10 sectors where we have competitiveness. And going forward, at least we need to create 25 sectors. So coming to the RBI policy, if you ask me, as Mr. Manoj mentioned, nothing, I would say that nothing could have been done by RBI. Even if they had raised the interest rate, liquidity levels would have been same. But as I said, it has an implication from the market point of view, where if you had increased the rate, it would have sent a signal to foreign investors that India is in line with the other countries. So whenever they do allocation for stock markets, then India would have got its due in terms of its share. Since we are not raised, to an extent we are at a disadvantage. That's all what I wanted to share. Thank you.
GDP number forecast for FY23 is lower than the previous number, 7.8 to 7.2. First quarter is fantastic. Q1. Scaling down in the future quarter, that's of huge concern. So we need to catch up. Tax collections are record high. Mutual fund collections are record high. As Krishnan always says, our SIP numbers are going up. Sanjeev, some thoughts from you?
Sir, there is some disturbance in the background, right? I couldn't hear you. Some banging noise from someone's background. Can't figure out.
Yeah, kindly mute all and then.
Sanjeev, are you there? Then Rakesh, some thoughts on RBI policy, your expectations and the future outlook. Vinod also, if you would like to contribute, you are welcome.
I will speak on this. Let us just finish the agenda first, because we are already on 44 and we have to cover a lot of things.
Rakesh?
I think he's not there. Yeah, he's there. Mr. Rakesh is there.
Rakesh, you are there? Sanjeev? Sanjeev?
Yes, Manoj. Good
Yeah,
morning.
Sanjeev, your thoughts on the current situation? Sanjeev? Yeah, your thoughts on the current situation? Inflation, interest rates, your expectations?
And market is good, ne?
You are happy?
Yeah.
Okay, that's very good. Rakesh? Anybody else would like to share any thoughts, any questions? We'll ensure every question gets addressed.
I think Mr. Krishnan Iyer wanted to speak.
Yeah, if your permission, sir, Manoj sir. Sir, just a thought on PLI scheme. Sir, every corporate is lining up to PLI scheme, but don't you think the PLI scheme itself can become a disincentive because it is like buying life insurance to save tax? Your take, Mr. Kannan, sir, if possible.
See, as I was telling you now, this PLI scheme, the main objective is that whatever you create, you have to export. We want to create competitive industries. Like I told you, as of today, only 10 industries are globally competitive. So, if you want to start somewhere and you want to give a big boost, you have to start. Actually, we started in 2014. That was called Make in India. We identified 25 sectors and said and told people, okay, come and do it. It was not happening at all. So, in fact, I would call this PLI scheme as a Make in India 2. At least we see that today, in the case of hydrogen and all these new emerging technologies, already some 3-4 companies have got license. So if you ask me if you have to start, one more thing you remember, whenever you talk about new industries, irrespective of the country in which you come from, it requires the support of government in the initial phase. That we saw in the case of solar power. So when they came first, we promised them 16 rupee 40 paisa per unit. But now companies are quoting at 2 rupees 75 paisa. So like that, when you have to kickstart a scheme, you need to give all these incentives. But once these people come, I can tell you, they create what is called the ecosystem for the industry. Ecosystem. India today is the hub for small car manufacture. For that, the ecosystem was actually created by Tata, which is the Tata small car. Nano. So the Tata Nano, they went to told the suppliers, I want battery at 2,000 rupees, tire at 3,000 rupees. So like that, they went and created an ecosystem. And today, if you talk about small cars in the world, India is number 1. So somebody comes, they start the setup. Then what happens? The ecosystem develops. Then many more players come. Then it becomes a big industry. So that is what we are expecting that it will happen in some of these PLI sectors, where of course it will start with 4-5 people. So when they start, the ecosystem gets created, then it attracts other players, they come, and that is how the industry develops.
Okay, sir. Manoj sir, if I can just ask one more question.
Yeah, tell.
Just good insight again, Kannan sir. Sir, I don't know whether textile is part of PLI. Okay, just to correct my understanding.
It is technical textile. It is called
technical textile. Now, why? What is textile? You will agree that provides large-scale employment opportunities after agriculture. But when I go to popular brands, for example, let us assume Peter England, Van Heusen, which is a listed Aditya Birla. Many times, what is it that Bangladesh is able to do well? That are we missing something? Because
I will tell you.
Because Peter England, etc. Some shirts, branded shirts, they get it manufactured from Bangladesh. What's it that they are doing right?
I will tell you. India was number 2 in textile exports after China. So today we are number 4. China, in fact, 86% of exports of Bangladesh are apparels. Vietnam, then India. So the Bangladesh ambassador was here in Mumbai. So I asked him a simple question. Sir, yours is a small country. And you have taken over us in textiles. How was it possible? He said simple. Only one answer. He said that in Bangladesh, they allow every type of fiber to be imported. High quality fiber. So when they import high quality fiber, they are able to produce high quality products which are high value. But in India, I believe there is already we have producers in these sectors. I don't know whether it is Reliance or whether it is Aditya Birla. So these people go and tell government that don't allow free import of these fibers. So it becomes costlier. So
Okay.
he says that the free import of all types of fibers in Bangladesh, they are able, in fact, many of the Indian companies went and set up textile units in Bangladesh.
Yes.
Yeah. So the main reason is this.
Okay,
They allow a free import of all types of raw materials.
Okay, great. Good insights again.
The PLI scheme and the Australia trade deal, which has just happened, they are meant to leapfrog the export.
Yeah.
It will happen in due course of time, but incidentally, it is triggered by incentives because the industry is used to incentives. They feel they are getting something, but often they are giving much more because what they get is just a passback of the huge taxes being recovered by the government. Unmesh Narvekar, your thoughts on the current situation and the RBI policy? Unmesh?
Yeah. Thank you, sir. See, I think that the boost is required. RBI, whatever the measures they are taking, yes, definitely. But still more is required. Basically, the MSME sector, which is the growth engine for the country, either it may be an employment opportunity or creating the income or creating the wealth also. We need something more to be done from that angle for that sector, and which is, I think, missing, not been done up to the mark either by the government level or it may be even the RBI level also. There should be some more thrust to be given on certain policy aspects as far as this MSME sector is concerned. And there is a lot more expectation from the RBI to do about this thing. It may be if you really want to bring out the economy back on the level, on the growth level, the most importantly the MSME sector, which is still struggling, and we need a lot of RBI has to take a major role in this activity, because I have seen the bankers are still reluctant to finance the MSMEs. I have seen they are not even increasing their limits because of these certain reasons. They are expecting that there may be some problems. So that type of attitude is still in the banker, though there may be from the upper level, they may be having some restrictions to lend. But the organization or the MSME which are there with you for 10 years, you know their business style, business models. Here, if you are giving them hand support that is done at the right time, sustainability will be the issue for the MSME. Bigger corporates are definitely the players who are doing many things, but they have the capacity to do like that, which is not the case with the MSME. I think my point will be definitely the RBI has to come up with some sort of schemes. They will give boost to the MSMEs. A lot more is expected from RBI.
Well, that's batting for SMEs. It's really vital. They have been struggling. SME, finance, NBFCs, funding SMEs are facing a tough time. Even the banks are going slow on funding SME, although there is a big lip service on retail. But for healthy SMEs, there is no dearth of funds. But many of them need to survive, revive, and thrive. So accommodative stance, how long it continues till the SMEs are able to grow in line with expectations. Anybody else would like to contribute any thoughts? Lots of things are happening. We have seen huge investments coming from overseas. Adani Group, 3 companies getting very good investments from Middle East and money coming in at high valuation. Adani moves at the rank in the top 10 wealthiest persons. Good to see more Indians moving up the ranks. Top 6, if maybe even for a day, and ultimately slipping behind and maybe ultimately would recover. It is all thanks to the growth in commodity cycle and infrastructure that has helped the group. Ruchi Soya IPO, ultimately it went through successfully. Allotment has come and still there is a big divergence between the FPO price and the current price of over 25%, right? So this shows a huge opportunity. Let us see when supply comes next week, how much money is left on the table. But the consumer story driving strong. Mergers, HDFC Bank, HDFC merger, because NBFC's cost of fund is high. Banks have a lower cost. Mergers bring synergies, moving up the ranks, topmost market cap. So creating space for maybe one more company in the Nifty when LIC gives its debut with the IPO, hopefully sooner than later. For lots of developments happening. Result season is started. Some basic numbers are coming in from banks and NBFCs. The headline number, deposit growth in some of the banks gives cause for cheer, optimism, advances growth. HDFC Bank ultimately meeting is a track record of 20%. Bajaj Finance, etc. Healthy growth, collections efficiency also improving, whether it is IDFC First Bank or Bandhan or Bajaj Finance or the top tier banks. Huge importance, huge developments. It's really happening. So lots of development. Looking forward to many investors are looking forward to the result season next week, and the month ahead will differentiate between the good, bad, and ugly, whether in terms of results or whether in terms of prices, the trends. But so far the trend is positive thanks to the accommodative stance of RBI and big deals getting announced like India-Australia deal, a huge funding coming in from abroad to some of the largest companies. Any other thoughts? Sanjeev?
This merger thing, HDFC Bank and HDFC, it will also bring about a change. No?
Major change, major change.
Major change, yes.
A company which has been a pioneer in housing finance.
Right.
And says the son is growing old to take care of the father. It's a path-breaking statement. So merger will take maybe about a year, maybe up to a maximum 18 months. But the RBI governor has responded in his speech also, an interaction about the merger proposal. So synergy will come. This shows the size of Indian companies and banks moving up. It was a dream, Indian banks being the best managed. They did not have size. Now size is coming, and hopefully this is not the one-off merger. There will be many, many more mergers, many more NBFCs looking to be merged. Maybe consolidation will happen. So synergies will come, and in the fortune scale, top 100, top 50, there will be more Indian financial institutions. Mergers show the way. The growth also shows the way. 20% advances growth, HDFC Bank, 20% growth, mutual fund industry. So India is really roaring ahead, growing up fast. So really, really wonderful. Great point have been raised. So wonderful. Any other thoughts before we close for the day?
Manoj, the cash withdrawal now possible without card. That could be one giving boost to the digital money. That is a good thing RBI has taken in the RBI policy. Now you can withdraw the money, and even that you can withdraw the money from any ATM of any bank. That should happen very fast. That will be helping a lot. As of now, we can do without card. Now starting with after this policy, that will be a great boost to the digital economy, and that will definitely have larger impact on these things, digital economy. I think that is one good thing what I see in the RBI policy.
Indeed, a very major step in terms of technology.
Technology, yes, absolutely.
And also UPI, the limit increasing to 5 lakhs for IPOs.
Yes.
A big jump from 2 lakhs to 5 lakhs. So quite interesting.
We can close, huh?
After Kannan,
Yeah.
a final take from you on the way ahead, and then we can close the session.
So like we discussed now, one is this mutual funds you discussed. As we are all aware, this any mutual fund can hold only 10% of a single company. So now we find that HDFC and HDFC Bank, many mutual funds are holding 14 to 15%. So that is one area where I don't know, there will be a lot of restructuring of portfolios of mutual funds when this merger happens. I don't know how that is going to affect the dynamics of mutual fund industry, because these two are the major stocks. And in terms of RBI, how it will move, already they indicated that everybody is saying that next time they are going to increase the rate. According to me, they should increase the rates this time itself, mainly from the point of view of foreign portfolio investor, not for anything else. So only it would have served only that purpose. So they have to increase the rate. Second point. And third, of course, Mr. Krishnan Iyer was saying how this PLI scheme was going to kickstart the economic growth. Like I said, earlier when the policies were being made, there was no focus on implementation. But now you have this Gati Sakti plan, you have this PLI scheme, all these schemes. Now government is really serious about implementing them. So once they start implementing these big schemes, we will see a big change. In fact, like I was telling you, Australia has invested $20 billion in India. India has invested $20 billion in Australia. So now they say that it can go up by 3-4 times. I think the last meeting also I told you, a country like Canada has invested $80 billion in India. Japan has invested $100 billion. Now you will find countries like Abu Dhabi, Saudi Arabia, they all will bring money into India. And I am sure these funds are going to make our life easy in terms of implementing infrastructure projects. And plus, it is going to increase the relationship between these countries. My only point is that I was speaking in a webinar on oil prices 2-3 weeks ago. So India, we have enough relationships with the countries which are rich in oil. Like Russia now, they are willing to give oil to us at $35, lower than the pre-war price. Similarly, Iran will supply at a similar price. So maybe if we can negotiate with the countries like Saudi Arabia, United Arab Emirates, if we are able to get into a long-term contract for oil between $35 to $40 per barrel with these 5-6 countries in the world, then of course the big elephant in the room in India, especially our economic management, is all about this oil price. So that one risk which we can do away with. These are all some of the thoughts which I thought I will share. Thank you.
Yeah, Manoj, fortunately yesterday I attended one program. It was ET group has organized and Times Network jointly with IDFC was the sponsor. The Taj and Bandra program was there, which is attended by the speakers were Hiranandani, then Ajay Thakur from BSc, and few of the tech savvies who are into startups, and then followed by even the Minister for State Vishwajit Kadam. The discussion was basically maximum cities, maximum wealth, or that rather more on wealth creation, along with the new developments. The mute question is that maximization can be done. The more focus was creating the infrastructure, putting the money or resources in development of more cities, all these things. And I think the all the speakers were quite now the economy is taking a good shape, moving towards on the growth level. And the focus really was on putting a lot of investments in the basic infrastructure so that the city should be more comfortable to live. And even the Ajay Thakur has also expressed the views that yes, more and more companies are coming for the IPOs, even the SME and the major corporates also. Still a volatility in the market, but that's the nature of share market itself. But yes, the people are more into investing the equities, even the small investors, retail investors I'm talking, apart from the FIs. But so that is a good sign because there are no options for the investors also to invest because FD's rate, the bank rates are hardly fixed deposit rates are 4 to 5%. looking for some more avenues where there will be some sort of return. That's also giving some boost to the economy because the funds coming from the retail sector to the equities also, equity participation directly or indirectly through the either the mutual funds route or maybe the share market routes. So that is giving some momentum to the economy also. These are some of the views from them also. It was very nice discussion. It was a couple of hours more evening, say, almost 6:30 onwards to 30 onwards. Very nice, but it was. Yes, sir.
Now, Manoj sir, I have one question, if I can. Just
Yeah, quickly before we.
no, yeah, just maybe Rajnatham sir can answer this. The Russia crude, apart from the favorable rate, see in past we have not paid in dollars. We have always paid in rupees. So is it also this time? So that is again a double win-win. In 2015, similar deal was sealed by the current government in rupees only. We didn't pay dollar. Correct my understanding, sir.
So India always had a rupee trade agreement, even with Russia 40 years ago.
Oh, that's great.
And in Iran, they were always having a rupee agreement, which was operated by UCO Bank. UCO Bank, I don't know, IDBI Bank was also involved. So, so there is a rupee account which was operating, where within that, the only problem is that when we import, those people have to again import from India to that extent. Something of that kind was happening. So from India, we used to export agricultural produce, medicines, etc. to Iran. Russia ruble agreement is there, I think, from, I don't know, maybe for 49, 50, I don't know. Very long time we had an agreement. At one time, we used to have balance of 15,000 crores about 30 years ago. I don't know whether that type of agreement is still there. But what governor said yesterday, it is being discussed and they are yet to formulate the scheme. So it is not yet final. But they are planning to operate it through UCO Bank of Union Bank of India.
Okay, thanks for the insight, sir.